5 years ago this month, Dodd-Frank was signed into law. Undoubtedly, it is the most sweeping, dramatic rewrite of banking and capital markets laws since the New Deal. Weighing in at 2,300 pages, 400 new rules. It is clearly dramatic. Whether fan or detractor, this committee would be negligent if we weren't vigilant in our oversight in both the impact and the implementation of Dodd-Frank. Negligent we will not be.
When Dodd-Frank was enacted 5 years ago this month, Senator Elizabeth Warren and President Obama promised Americans that this law would lift the economy, that their hard-earned money would be safer, that markets would be more stable, and that no one institution would threaten the safety and soundness of the global financial system. As we've seen this law implemented, it has left much to be desired.
If I were to go down a checklist with the panel here, too big to fail continues. In fact, Dodd-Frank institutionalized it. Our secondary mortgage market remains in limbo. Insurance regulation remains fragmented. Securities regulatory arbitrage is still possible with the SEC and CFTC as competing regulators.
The CFPB under Dodd-Frank has continued to expand its influence into areas it has no authority under, something even Director Cordray told me himself that the law doesn't address.
We have the lowest labor participation rate in 4 decades. For the first time, I think you'd mentioned this, the Brookings Institution report coming out saying we have more small businesses shutting down than there are new business startups in this country. We're suffering under $2 trillion worth of regulatory costs, which is driving up costs.
Well, what is undebatable is the fact that since the passage of Dodd-Frank, the big banks are now bigger. The small banks are now fewer. In other words, even more banking assets are now concentrated in the so-called too-big-to-fail firms. Pray tell, how does this improve financial stability?